business or are you running a business? Valuation is the ultimate KPI.
Hey there, it's Mike Langford with another episode of the Modern Financial Advisor podcast, brought to you by Trulytics, the one and only comprehensive advisor transition management platform. This week on the show, I have a very special treat for you. I have Gil Baumgarten, the founder and president of Segment Wealth Management, with me. Now, what makes Gil such a special treat? Well, I would argue that Gil has built a business that is the envy of the wealth management world, the financial advisory business world, however you want to define it. He is a solo advisor who is managing over $1.2 billion in AUM with a very manageable client roster, with a very small team, operating a business that's pretty simple, actually, the way that he's constructed it. And that's probably what has allowed him to grow the business as rapidly as he has and have it be as efficient and effective as it is. So it's just a wonderful story. Gil goes into the full details. He actually goes kind of full open kimono and shares a lot of details that you wouldn't expect somebody to share. But hey, look, rising tide lifts all boats. He's actually written a book talking about the process and how he's built his business and why he feels it is best for clients. And it's kind of like a roadmap for the modern financial advisor, right? If you'd like to build a business that's really, really big, that is generating millions and millions of dollars every year, this might be the episode of the podcast for you. So you're going to love it. Actually, Gil's a fantastic dude to talk to. I absolutely loved him. I enjoyed the book. I listened to the audiobook, as you'll hear me say. He went on many walks with me and my dog. So awesome stuff. You're going to love it. Okay, before we get to the conversation with Gil, please do make sure you like and subscribe to the podcast on your favorite podcast platform, whether that's Apple Podcasts, Spotify, Stitcher, SoundCloud, the YouTubes, or wherever you like to get your podcast jam on. And if you have a question or suggestion for a guest or a topic for the show, just like Gil's team, they suggested Gil as a guest for the show, please reach out, podcast@trulytics.com, or swing by trulytics.com and use the little contact form there, or click on Ian Carnell's face down in the lower right-hand corner. Use that contact there. We would love to hear from you. All right, let's get to the show, the conversation with Gil Baumgarten. Well, Gil Baumgarten, so wonderful to have you on the Modern Financial Advisor podcast. How are you, sir? Welcome to the show.
Great. How are you doing?
I'm fantastic. This is great. We're talking before we click record here about our respective Thanksgiving holidays. Sounds like both of us had a fantastic time, and we're nice and refreshed and ready to get at it. Right? It's feeling
You
great.
bet.
Exactly. Well, listen, your team reached out to have you on the show, and originally when the pitch came in, I talked about a lot of the things that you can talk about. And anybody who's heard you speak or heard you interviewed on a podcast or a video at any point in time, has heard like some of your messaging tends to be more retail focused, talking to the financial consumer. But I, and you and I chatting in a prep call and, seeing how successful you have been at building your business there, I'm like, I want to have this guy on to talk about some of like his stuff to share with our audience of financial advisors and executives at wealth management firms, because you just have such wisdom to share. So I'm thrilled to have you on the show for that topic.
Thank you.
Yeah. So in a recent episode, we had Kieran Bowl from Price Metrics by McKinsey. McKinsey, one of the biggest consulting and research firms out there, and he and his team have looked at the real data, like this is data right out of the computer systems from wealth management firms on 70,000 financial advisors and the performance or the lack of performance thereof. And one of the things they found was since
performance
2015,
as an advisor or performance in their portfolios?
Performance as an advisor, right? So just looking at like how many clients they have, how much client growth they have, and all that type of stuff, like things that happen as a business person, right? As an individual advisor. One of the things they found, and this probably doesn't surprise you, is that 75% of the asset growth since 2015 for financial advisors has come just from market performance.
Yeah,
Meaning
that's not that surprising.
Yeah, and the thing that it really just means, right, is most advisors aren't growing their business. They're not adding new clients. They're not adding new assets from existing clients. And it gets worse so when Kieran and I had that conversation, he found that when he dove into the data a little bit deeper, 40% of today's advisors, like active advisors today, are experiencing negative net flows, right? Meaning money is leaving.
In the wirehouse channel, that's been the case for a really long time.
Yeah,
So
it's
that doesn't
huge.
surprise me. My numbers are more like 50-50.
Yeah.
About 50% of our asset growth has been performance dollars, and the other 50% has been inflows.
Okay.
So,
Yeah.
I guess I feel pretty good about that relative to your 75%.
Well, what's interesting about it, by the way, it shouldn't surprise anybody. It's wonderful. I'm glad you're willing to share that. It makes sense, right? Like we've had a very robust bull market for years and years, right? And so performance is obviously going to play a big role in the growth. And as a friend of mine, Jeff Montgomery here in Austin says, there's been a lot of free money in the industry these last few years. Because hey, listen, if I do nothing, I'm going to make more money. The market went up, like that type of thing happened. Yeah. So one of the things I wanted to talk about with you, and maybe a great way to kick this off, and I know this has been a long intro, so I do apologize. I'm monopolizing the talking time here. You have grown your business to a size and a scale that most advisors dream of achieving. It's so very evident. We haven't talked about any of the numbers of your business. But I wonder if you might be willing to share some high-level details about Segment Wealth Management and your journey since you made the decision years ago to become an RIA versus from the wirehouse and business.
Yeah. So when I started the business in 2010, I took about $250 million from my former custodian, I was a UBS broker at that time. Mm-hmm. I spent 10 years at UBS and 15 years before that at Smith Barney. I'm an old E.F. Hutton guy from the original Smith Barney days.
Yeah.
And we have $1 billion more than that now. And so we're somewhere between $1.2 billion and $1.3 billion in assets. One of the more unusual things about my practice is that I don't have any partners. That's not a team of 4 advisors contributing assets into a single pool. That's just my book of business. And that $1 billion increase has been about $500 million worth of profits on that money and another $500 million of inflows. And we continue to grow the business. I have $100 million of incoming right now in 5 households. And so it continues to grow and the accounts get bigger and bigger. And that's really been the growth part of the business. The real growth of that $1 billion has been in the $15 million and bigger household. We had, I think I had two households at UBS bigger than 20 million, and I have like 27 of those now. So
that's amazing.
That's been really the growth of the business has been in the ultra high net worth space.
I'm glad you brought that up because I want to dive into that a little bit later because I think many advisors are just going like, oh wow, they're hearing some of these things that you're sharing, and that's one of the things that just attracted me to have you on the show is hearing this level of growth, especially since what I've just read off at the beginning of the show is most advisors aren't growing and many are struggling to grow and many are shrinking, and I don't think it's that most of them don't want to grow. I'm sure that we're going to talk about some of them getting to the happiness zone, if you will. But you mentioned, in prep, you mentioned your business is relatively small in terms of the actual number of clients, right? Like, many advisors might hear like, oh, he's got
210 households. Yeah. 210 households. I spend most of my time with the top 50. Okay. And the top 50 households have $1 billion with us.
Okay.
And so if you look at the math of that, you could easily conclude I should carve off the bottom 75% of my book and only focus on the top.
Yeah.
And there's some truth to that. But the ones at the bottom pay a larger fee and take less time. So the margin on those still exists. And I've decided not to do that. Imagine also the emotional toll it would take both on me and on the clients that I've done business with for 25 or 30 years. And they're still $1 million household, would not make a new household for me under my current metrics, but I can't really show those people the door and say, hey, this isn't working for me anymore. That's such a cold way of doing business. I just absorb the responsibility of that within my business model, and I make them pay for that. And even then, they're not paying even what they used to pay at UBS. All of my business is low fee relative to a broker-dealer model. So I don't feel like I'm taking advantage of them to make them pay their fair share. So
one of the things that comes
to address that.
One of the things that comes through when anybody who spends any time with you or listens to your book, as I did, we're going to talk a little bit about that later, is you really care about your clients, like deeply, deeply, right? Like it's been something that has been a current thread for you throughout your business. It just really comes through.
That probably is the reason why advisors might not be growing their business if they don't approach it that way. At the core, there's so many little nuances of the business that if the basic setup of the tee shot isn't to focus on what's best for the client, it's not going to take the client very long to figure that out. Wow. And that manifests itself in things like a transactional methodology. Hey, Mr. Jones, let me tell you about this new structured note that we've got. I can tell you Mr. Jones is going to have his defenses up. So the whole transactional mindset at a broker-dealer model of having to talk to the client, even if you are client-centric and even if you are trying to do the best thing for the client, the whole setup of having to talk to the client and talk the client into something comes across. And much of the way that comes across is that people list features and benefits, they don't list drawbacks. And one of the things that I think is the key to the growth of my business is my willingness to throw all my cards on the table. And when I talk to a client about how something works, I tell them the good part and the bad part. And then I guide them to a decision, but ultimately the decision is theirs. And I am agnostic about the outcome. In the broker-dealer model, you cannot be agnostic about the outcome. And that agnosticism comes across in the way it's communicated to the client. I know that I am naturally resistant to people who try to convince me to do something. I always know that they're not telling me the full story. And there is a drawback to everything. And the best thing an advisor can be doing to gain trust with a client is to tell them the bad parts of everything, whether it be the cost, whether it be the taxes, whether it be illiquidity, whether it be the cheaper ways to accomplish the same thing. Structured notes come to mind. Many structured notes are just a 4% commission way to accomplish something that's relatively free in the marketplace. And so that kind of talking people into things is what will drive a wedge between the advisor and the client. And in many cases, it's insurmountable. So
No, and I agree. It is such a better way of doing business, of being able to sit across from somebody and saying, like, I care about you. Your interests are my interests, right? I want to see you achieve your financial goals, right? And live the life you want to live. Let me give you the range of choices. Let me give you the levers we can pull, right? We can save more now and retire earlier as a very basic one, right? Or we can live more now and retire later, right? We can consume and enjoy more of life now. So all of those things come on the table, and you are, from a fee perspective, are aligned with that, because, like, look, I'm managing your assets. I'm going to manage the assets you give me. I'm going to give you the advice on those assets. We're going to do, the proper appropriate financial planning and estate planning and all those types of things as well. But my goal is just help you have the life you want to have, and it really does come across. And I just love it, the fact that you what triggered that for me was just hearing how, like, you have clients who, like you said, they would not be qualify to be your current clients if they had to join the firm now, if they were coming to you now, but you're keeping them. Why? Because you care, and it comes across.
That's right.
This is kind of a good segue into, you hinted on it, like why maybe this may be why some advisors aren't growing, is that they kind of lose that, or maybe that's just hasn't been in their business DNA so far. One thing that I've talked about this frequently on this show is that how easy it is for an advisor to kind of plateau. Right. I always, they get a little fat and happy, right? Like they start making $300,000 to $500,000 a year. They're working about 40 hours a week, playing a ton of golf, life gets pretty good, right? So, this is probably, I think, one of the most common reasons for just stopping growth. It's like, why would I grow anymore? Like, I'm doing all the things I want to do. I'm making pretty good money. And if the market goes up, I make more money. Awesome, right?
Yeah.
But you, as we described at the early parts, you've grown your business to be just enviably great size while keeping it really kind of constrained in terms of operationally manageable.
Yeah.
What are some of the strategies and techniques that you had to employ for yourself, I guess, to keep growing through what must have felt like a few plateaus over the year? I'm sure there have been some times in your life where you're like,
oh yeah,
this is awesome.
Yeah. I have not experienced any plateaus in the RIA model, but when I was in the broker-dealer model, I had a plateau.
Okay.
So I was probably 15 years licensed.
Okay.
The last 5 years. So I left at the 25-year mark. And so I've been 11 years, so 36, 37 years in the business. So the first 25 years inside the broker-dealer model. The last 7 or 8 years of that, I had relatively little growth. For a number of reasons. I don't think it was laziness on my part. I don't think I was complacent. I just don't think I was in the business model where I really thought that I could advocate for the client. I found myself bumping up against the sides of the bumpers on the bowling lane that the firm had set up for me. And I never really could get deep enough into the client relationship because some of the things that had to be done we couldn't bill for, or it just didn't fit the business model. I just felt constrained. And I thought that the RIA business would be enough open platform to be able to address those issues. One of those issues is doing nonprofit business for free. So I ran up against situations where I would try to do business with a church in order to meet the board members and develop relationships with them. And I wanted to be the low-cost provider, even to the point of doing it pro bono. I thought I was doing my community a service that ultimately would benefit me. My firm wanted no part of it. It had to fit inside of our profit module, and in no way are we going to waive the fees for a particular client, even if it's a nonprofit. I think that's super short-sighted. In my RIA business, I have a half a dozen church or parachurch ministries that I provide free counseling to them, and I do business with the board members in almost every case. So I think it's very short-sighted, but that's just something that doesn't fit into their business model, and it fits into mine very well. So anyhow, I can waive fees for anybody that I want to, and transactional business is now free. So you're talking about very skinny business for a nonprofit, and it shows up in the results after the fact. So
yeah. So it really sounds like for you that, part of it was creating an environment for yourself where you felt like you had the freedom to grow in the way that you wanted to grow, right? There was friction before, right? And like in growing faster and more accelerated, there was some friction on the growth process. And by the way, there is always going to be some level of friction, right? Sales, getting out there and trying to,
You bet.
But it sounds like once you remove some of the friction, you just kept cruising.
The way I would articulate that is that I now have the freedom to speak absolute truth.
Yeah.
Whatever that truth might be. And in the past, I had to speak truth as it was interpreted to fit within my business model.
Yeah.
And that disconnect was very disheartening for me, and I think was probably the source of my lack of growth. I just could not speak absolute truths as I knew them to be. I could only speak the truths as they applied to the way I was going to get paid. Yeah. And people pick up on that. Just simply because you're not saying it doesn't mean that they don't hear it.
Yeah. Yeah, it's a little bit of that, what they call cognitive dissonance, right? Like your brain is trying to do two things at once. Like, here's what I actually believe, and it's inside you. Like, I believe that this is the right way forward. I can't actually do that because that belief is incongruent with the reality that I have to be in the real out there. And like you said, it causes a little bit of like, it's funny. I know, this isn't meant to be a psychological podcast here, psychologically examining. But
What it is.
It is. There is a little bit. We all experience that. Every once in a while, you're feeling some frustration, or like you said, you're banging up against a wall from a growth perspective in one area of your life or another, whether it's business or personal life. And more often than not, it's something that it's something that there's some sort of friction in yourself that like I might need to make a change here, and you did.
Yeah. I had a series of aha moments.
Yeah.
And one of the aha moments was that in the annuitization of my process, in order to annuitize my business, I hired out-of-house money managers to create a wrapped business. And I just found that the fees were too high, the underperformance was too great, and a more passive methodology would just simply be better for the client. And I had a hard time articulating that. And actually, I got into a shouting match with my boss about wanting to run 100% ETF portfolios. And he told me that I would regret the day that I did that. And nothing could be further from the truth. And the reason why he said that is that it didn't fit with his business model for me to be doing low fee business that didn't have a 12B1 attached to it. Yeah. And so there was all of these conflicts. And I had another aha moment in dealing with a wrap manager, a very large wrap manager, and the way they articulated their investment process would in fact lead to an index return. And so they're talking words of active management, but the process of decision making was passive. And so there's 100 basis points of disconnect when you're having to pay them to provide a passive methodology that they're articulating as active. Yeah. And I had the head slap moment where I went, wait a minute. And so what I ultimately decided is that if I internalized all of the investment management process and went with a passive methodology and articulated it as such to clients, and then could articulate the tax advantages and fee advantages that would outrun all of the decision-making advantages, which were so elusive to producing alpha, that the client would have a much better experience as long as they understood it. Yeah. And so I had to develop a way to articulate that. And once I began to articulate that, these $10 and $20 million accounts started to show up on my doorstep. And so that's essentially what happened. And so you're not going to ask me this, but I'm going to share it because I think it'll be valuable for your listeners to know. My average fee is 58 basis points. Okay. And so when I'm talking about using ETF products, there's another 19 basis points to the extent that we use ETF products. Right. And in many cases, we don't, because we manage individual securities far more often than we manage all ETF portfolios, even though that's a significant part of our business. And my profit margin on that business is 69%. So 69% of every dollar that I generate in revenue ends up in my pocket. And one of the other aha moments along those same lines that I really decided is that if I'm going after these $10 and $20 million accounts, which I wanted to when I was at UBS, if I get one of those, and let's say I'm charging a $10 million account 75 basis points, that's $75,000 worth of revenue. Mm-hmm. In that business model, I never was going to make more than 41% on that money. It didn't require any new employees. It didn't require any new office space, no technology. There were zero costs to the firm for acquiring that $75,000 worth of revenue, and all I was ever going to get was 41% of it. Mm-hmm. So 59% of all those new revenue dollars ended up at the firm, for which they had zero cost. I didn't have zero cost because I had effort to find that relationship. But when I look at my business model now and I get $75,000 worth of revenue, what do you think the profit margin is on those dollars? Right. It crowds 100% until I get to $100 million worth of assets and I have to hire another employee. Yeah. And so that aha moment of how profitable each new relationship is really drove a wedge between me and my broker-dealer. And when they started using language about I was the largest expense in the way the pie got divvied up, oh, wait a minute. The revenue dollar starts with me. The revenue dollar doesn't start with you. Therefore, your 59% is my largest expense by a wide margin. And I think that they're a little confused about where the revenue dollar starts. And so those were some aha moments that really drove me out of the broker-dealer world.
That's that. It is an amazing business. I'm blanking on his name. It'll come to me. I know it. Oh, Dan Caprill. That's his name. I had him on a show a year and a half or so ago, and he talked about financial advisors should seek to be qualified to be one of their own clients. Like many advisors wouldn't be qualified to be their own clients, right? Because they're not managing a profitable business, and a lot of the elements were exactly what you just described there, right? They're just not looking at how their business is set up. And one of the things that you talked about during the prep call is that you run, as you termed it, an extraordinarily simple business. I actually took notes, and it really stuck out to me that you called it that. So I wonder if you might be able to share some of the details of the simplicity of your business, because I know that, sometimes when we hear that somebody has achieved something that we would like to achieve, we often get bogged down in our heads thinking about how hard it's going to be to do that. And it's not to say that you just waved a magic wand and got there. You obviously put an incredible amount of work in there. But part of the work you did was making sure the business was simple and efficient to run from an operational perspective. And I think also simple and easier for clients to understand the services that you offer.
When it's simple, it is easy to master the articulation as to what makes it so fantastic for the clients. If you leave a lot of, let me say, if you put a lot of products on your plate, mm-hmm. and you show up and start assembling the client's portfolio off of the plate, it doesn't have a lot of repeatability to it. And you're probably not going to be a master of discussing all the nuances of all those things that you have on your plate. And you're subject to whims of the marketplace that you can't control. And just because somebody wants the new hot way of doing things and you could make some easy money by providing it to them, doesn't make it good for the client. It doesn't make it good for your business. And so I just found themes that continued to repeat in my interaction with clients. And I thought, I could solve 95% of these clients' issues by doing 4 things. And those 4 things are really all we do. And so all clients who want equity exposure want large cap equity exposure. That is also the spot that is the very hardest to generate alpha. And tax management and fee management are really the key to superior performance when all you're doing is pursuing beta. Mm-hmm. The other things that the clients want would be some type of a diversified portfolio of mutual funds. Well, if you're in the mutual fund business and you haven't been struck by a 1099 from all the activity of other investors affecting the taxability of your client, you haven't been paying close attention to the ETF world that doesn't operate like that. The other thing that clients want is an opportunity for spectacular growth. And so we run a large cap growth portfolio that's very aggressively managed. So we run a large cap core equity rising dividend tax efficient portfolio. So it is the same thing you would get from any large cap manager, except it's low cost, and it has low turnover, and it has rising cash flow, which all clients ultimately want. And it's easy to articulate why that's a benefit to them. Clients like the possibility of diversification inside of a mutual fund, and they understand the tax problems and the cost problems, so don't give them a mutual fund. Put them in an active managed ETF program, and we run that too, kind of like a core satellite. And then we run an aggressive growth strategy. But then the fourth leg of it would be, what about clients that don't want full beta participation? So clients like municipal bonds as a way to put ice cubes into a hot cup of coffee and chill the whole mixture down. And even though returns are near zero in muni bonds, the job is not to get a return from the muni bonds. It's simply to make it not be a stock when the stock market falls apart. So those are our 4 lines of business. Large cap core equity rising dividend, tax efficient. Core satellite, all ETF. Aggressive growth strategy where clients can own some racy names that they have heard before and have a lot of beta, which we give to them in very small doses. and then a muni bond overlay for clients, and not all clients have it, for clients who want reduced beta. And so that's all we do. And we can articulate how I can solve virtually any issue that the client has with those four strategies in some combination. And it makes me an expert at discussing every one of those. And I'll tell you the other thing it does. If I bump in, we have 1,100 account numbers, 220 households. I can bump into a client at the grocery store, and I know off the top of my head exactly what they've got. If they walk up to me and say, hey, how's my account doing? Well, you've got this dividend strategy, you've got this strategy. I already know in my head essentially how big the client is, essentially how their money is divided up. I don't need any notes. I don't need any reports. I know how all the accounts are doing. I know all the nuances of every one of the positions in the account, and on the fly, I can address with that client the specifics of their portfolio because I don't have that many clients and I don't have that many positions to be an expert in. And that is powerful when you are on the receiving end of instant authority on the topics at hand. And you cannot do that when you have a complicated book of business that's chock full of products that you don't fully understand.
I love that. I love that. And you know what's interesting? I've experienced this. Maybe I'm speaking solely for myself, but I doubt it. As an advisor, you want to feel like the client sees you as valuable, right? That you're doing something. So oftentimes there is a feeling like you have to make the product a little more complicated, a little more challenging, so the client thinks that you are. Yeah,
we complicate the ecosystem so that we can be the key to unlocking it.
That's right. That's right. Exactly. And historically, by the way, there's been some reality of why that was, right? I think you and I, when we were talking the prep call, I got my career started answering phones for mutual fund companies, all right? And back in BFDS, Boston Financial Data Services, before the internet, right before the internet became a thing, people used to call to ask for what's the closing price for their fund.
Oh yeah,
or they
we did that too.
Yeah, send us a prospectus. So they had to call. This is like 1994, right? This is like I'm fresh out of college. Actually, I was technically still in college. I was doing the 4 to midnight shift, answering the phones and studying, because after 8 o'clock, nobody calls. So, but like there was structural opacity to the information, right? It was because information was hard to get to. The average consumer didn't have the equipment or the resources to get the resources financially as well to get the information. So as an advisor, you were doing a service by providing this information and so forth. And now anybody can fire up their phone and get this information, right? So it's just, it's freely available. So you're not an information broker as much as you used to be, right? And so as you said, like, don't need to overcomplicate it. Your goal, as you say in the book, is to kind of save the client from themselves, to help them emotionally. You're a dispassionate guide on their financial journey.
Yeah. John Bogle was correct when he said that a financial advisor's most valuable purpose is to keep the client in their seat. And that is true. And many clients underestimate their own weaknesses. And it's our job to point it out in a very nice and appealing way, but to let them know that they're really not qualified to go it alone. They will make a huge number of mistakes, most of which they will not admit to after the fact. And it's easy to articulate what those mistakes look like. And it does not take very much of doing it correctly to account for 58 basis points of fee.
That's right.
Not to mention, what clients really get from that is peace of mind.
Yeah.
Peace of mind, hey, they could save the 58 basis points, assuming that they would make the same decisions as me, which they will not. And it is still their responsibility. People don't want that responsibility. They want a professional that's in their corner who understands how the sausage is made and just serve it up for me. And if the cost is low enough and the perceived value is high enough, they will beat a path to your door. And that is the mixture of the way we run the business.
Yeah.
And it has proved to be true. And my income is about 7 times 11 years later what it was when I left the broker-dealer world. And that doesn't count the fact that my UBS stock options, which got obliterated in 2008 and then struggled to recover since then, would only be worth a 20th of the enterprise value of what my business is worth if I were to sell it to a next generation advisor, or if I were to sell it to a private equity company who calls all the time trying to roll my business up into their business. So the economics for the advisor are just mind-blowing, and the economics are better for the client too. My clients probably pay 30% or less lower fees than they would have if I was still in the broker-dealer world. You put scale on that, and it's a win-win for everybody except the wirehouse. And I can live with that.
Yeah, yeah. You said something a little while back there about, helping to make the clients feel more confident, like they could do what you do, but they shouldn't do it, right? Type of thing. People can try to run their own money and so forth. But one of the things I've discovered over the years, and I'm sure you've more than discovered, is that even high net worth and ultra high net worth folks lack some fundamental knowledge of investing, right? Just because somebody made $30 million because they have a couple of they've got a gas station chain, or they started a tech company and the tech company got acquired, within 2 years, and suddenly they find themselves worth, $50 million. Like, oh, this is awesome. Like, that doesn't mean they know anything about investing in the stock market or protecting their wealth, right? And or tax advantaged accounts and how to use them, right?
Yeah.
One of the things I want to dive into, because you've been so open about this as it relates to ultra high net worth and high net worth folks, is in your book, Foolish, How Investors Get Worked Up and Worked Over by the System, by the way, and we'll make sure that we get also the links in the show notes to your book. And in person, you kind of are pretty open about that you grew up in a household of limited financial means.
Yeah.
That, you weren't like a silver spoon kid. Neither was I, by the way. Yet you serve, as you've talked about several times, clients that have tens of millions of dollars invested with your firm. So what kind of personal growth did you have to do in order to gain the confidence in yourself that you could go out and win those types of clients? Because I imagine many advisors may feel somewhat apprehensive. Like, I don't think I can go out and close a $20 million client because, you know how it works. Most advisors, when they get started in the business, they just start like throwing spaghetti at the wall. They'll take anybody who can fog a mirror as a client. You got some money? You want to be my client? Congratulations, you're my client.
Yeah, so, totally get it. I've been there, by the way.
Yeah, so you obviously had to do some growth yourself, right? I would imagine.
Yeah.
What was that process like for you?
Well, I'm kind of an engineer at my core.
Okay.
So you'll see a lot of successful brokers are really salesmen. I'm not a salesman. I'm kind of a brass tacks kind of guy. I will figure out how everything works, and I want to know every little bitty detail, because I need to be able to understand how it works in order to understand how it's going to benefit or it's going to harm me. So I think that my knowledge of the way mutual funds work, taxes work, fees work, whose hands are in the till, how all that stuff works in the ecosystem, I think is very good. And it's because I've been deliberate about figuring that out. And most people just aren't that curious, but they should be curious, because the way that comes across is when I get asked pretty much any kind of question, I have an explanation because I have a guiding light as to what it is that I'm trying to accomplish. And I can tell you what the shortcomings are to doing it any one of the number of ways, and why the reasons we do things the way we do it fit within that framework. And so I think if people understood how taxes work, they would have a very different investing methodology. The tax code is complicated. The tax code has some hot spots in it about things that are discouraged, and the tax code has things that are encouraged. And many Wall Street methodologies are contra to what would be encouraged by the tax code. And so I just lay out the framework of the way taxes work, and how if somebody understood the way those taxes work, they would choose a definite path to maneuver through that tax code. And most people don't understand the tax code, they don't talk about it, and the broker-dealers actually discourage discussion of it because they don't want the liability of it.
Yeah.
But I think you're leaving a lot of client money on the table by not discussing it. And once you demonstrate that you have a command of the positives and negatives of all things thought out, they're going to want to just do whatever you're doing.
Mm.
Eventually, you get to the point where you're explaining it, they don't understand it, but they understand that I understand it, and all they want to be is on my team. And so as long as they can't find a disadvantage to it, and they view it as advocacy minded, they're on board. And so that's the way we articulate it, to just simply be as truthful as possible about all the pros and cons, and then let them decide. And the other thing that you mentioned is that the older I've gotten and the more financial success that I've had, the more ambivalent I am about the outcome. I'm not here to convince them to do anything. I frankly don't care one way or another. I'm going to make millions of dollars whether they come and join me or whether they don't. And so it puts me in a position to be extremely agnostic about the outcome. And it's very compelling when you're on the receiving end of a discussion where you don't feel somebody's trying to nuance you into a particular type of decision. I'm just laying the facts out. Here's what we do. If you want to do it, great. If not, hey, that's fine. So that ambivalence about the outcome is a very powerful draw that most advisors don't have the benefit of being able to be in that position. They have to convince people.
Yeah.
And when you have to convince somebody, it's not as compelling.
Yeah. And that attitude that you just described, that ambivalence, that's not something you have to wait until you have a firm as large as yours to develop, right? You can develop that relatively. We talk about this. I do a lot of work in the startup ecosystem. And so one of the hot topics in the startup ecosystem is pitching to raise money, right? Yeah. And you, of course, you want investors to say yes. You want every investor that you go and pitch to say yes, please, we'll invest. We're going to invest some money in your company. But it's a numbers game. It really just is. You just go pitch them all, right? And keep refining your pitch. If you know that you've got a strong business, you've got that your business is something that is worth investing in, or if your firm is worth putting your client money to manage. If you know you've got something great. Not everybody is going to say yes, right?
Yeah.
It might not even be a no forever. It might just be a no for now. Who knows?
I've had that.
Yeah.
When I left UBS, one of my clients that I would have probably put in my top 25 relationships in terms of how good of a relationship I had, this investor said no. So when I left, and I was stunned by that because I had over 90% acceptance of the proposition to move from the wirehouse model into the RIA model. Mm-hmm. And this client was a total surprise to me that they would say no. And other of their family members, who I also did business with, said yes. So I maintained a connection to that client by way of the other family members that I did business with. And then 6 years later, the phone rings and it's the client, and they had figured out finally what it is that I was doing and what made it unique. And now they're a fantastic client and have sent us other clients. So I don't think they fully appreciated what that looked like. I think that being able to explain custody and what having a Schwab or a Fidelity in the background really looks like for the client, I think that after the fact that this person believed that they were just trusting me with all of their money, as opposed to just trusting me with the decision-making on their money. And I think once the light went on as to what that custody relationship looked like, they were like, oh my gosh, this is way better than what I perceived it to be. So a lot of no's are just temporary no's.
Yeah, that's fantastic. That's fantastic. I want to shift gears kind of to some more, I think, stuff that your work, your creative work, let's call it that, right? So we're gonna end this thing talking about your artwork, by the way. So start thinking. But I want to talk about the book in a little more detail here, because I bought the book, and as I was telling you before we clicked record, I got the Kindle version, and there's an audio add-on. And first of all, I was pleasantly surprised to hear your voice. So like, oh, Gil's actually reading his own book. You'd be surprised at how many authors don't.
Yeah.
I really enjoyed the book. You've got a fantastic way of making a listener and I guess a reader feel comfortable. Obviously, you do that with your clients and your team there. And you have a great way of boiling down complex things and making them easily digestible. And I think that's so important for this business because there's often on the client side a lot of anxiety about finances, right? People are very uncomfortable with
And
money.
there's a lot of intentionality on the part of the advisor to make it complicated.
Yeah.
And I think that's a big mistake. So anyhow, I'm sorry.
Yeah. No, that's okay. No, it's all right. This is a conversation. Interrupt away. It's funny. I found myself kind of nodding along a lot of the book, like, oh yeah, I've used that phrase before. I've used that way of explaining things. So I think it was fantastic. And like I told you at the beginning before we click record, you've been on a lot of walks with me and my dog. So that's great. It's been wonderful. So I think we're best friends now. This is great.
Very good. Thank you.
Yeah. So one of the things I wanted to ask you about, because I've had a few different authors on the shows over the years, is they hear about your approach for writing the book. Writing can be a hugely humbling experience. It's a lot of work. It can be maddening, the editorial process, or hitting a point where there's a writer's block, talk about a plateau, right? We're like, what do I say next type of thing. I guess I would love to hear about your process, I guess, first, but then also like, how's the book been received? Like, how have your clients or prospects received the book and how are you using the book as a team?
The process is maddening. The book turned out to be not what I thought it was going to be. I thought it would just be a typical investment book of, let me tell you how a mutual fund works. Let me tell you why an ETF is better. Let me tell you about how taxes work. And I did weave some of that into the story, but that isn't what makes the book unique. What makes the book unique is that it really shines a bright light on the downside of having money. The downside of having money comes from emotional distress. It comes from fear that you're going to get ripped off. It comes from the knots in your stomach in the middle of the night that you're not sure what's going to happen next or what you should be doing next, and just all of those issues. And then the more I got into it, back to my business being simple, I wanted to make the book simple too. And as my daughter actually helped me write the book, and as we were developing the framework for it, these recurring themes that probably are the things that I'm most passionate about kept coming up, and we decided just to cut a lot of things out of the book that had been originally in the framework of it. And so the first third of the book is basically about how Wall Street operates, some of the unseemly things that they do that jeopardizes the trust relationship. You would have to have pretty decent knowledge of the ecosystem to be able to dig into it and then have to explain it in a way that's understandable and in a way in which people can understand how they could be victimized by that. And a willingness to throw some cold water in the face of your broker-dealer, because the broker-dealers are the ones that are culpable in the majority of this. And if you're working for a wirehouse, they are going to want none of that story being told. So that's the first third of the book. And then the back 2/3 of the book is really about my journey as an investor, as a broker, but really mostly about the journey that investors get on and all of the demons that they've got. It's about idolatry with regard to money from a Christian standpoint, although it's not written as a Christian book. It's about stewardship. It's about giving, charitable. There's so many things that come into play in decision-making and motivations and what drives people. I had to really unearth a lot of that in order to kind of discuss what the decision-making ecosystem looked like and what an uphill battle it is for the typical person to deal with those demons. And so that's what the back 2/3 of the book looks like. So psychological exploration and motivation and ways to shortcut some of those bad habits. So
yeah. Well, as I can attest, again, I've got a finance degree. I have an MBA. I've studied, I've grown up in the industry, right? So most of the things that you covered from a purely informational perspective, I knew these things, and I was glad that somebody was articulating things kind of the way that I see the world too. Is wonderful. I recommend for any advisors should be buying this book too. While the book is actually, I think, intended for the consumer, the financial consumer, to be the reader, I think there's a lot of value in here for an advisor to read this book, because the way, as I said, the way that you take some of these concepts and you boil them down in a simple way that almost if an advisor would basically kind of steal the verbiage and use that to articulate it to their client or their prospect, I think they would have some success in the business if they are looking for growth. There's a lot of fantastic stuff there.
I think some advisors are going to have their blood boil a little bit.
Sure.
I don't think anybody can refute the things that I say.
Yeah.
A lot of it is personal experience. A lot of it is irrefutable, that this is just simply the way it works. But a lot of people aren't going to want to hear that story.
Sure,
and I think it's going to make some people uncomfortable, but possibly to the point of being motivated to make changes that would actually be good for them. So, it's just reality, and there are some hard truths that we talk about in the book.
Yeah. Well, we are a business that's in evolution, right? The wealth management space is evolving rapidly, right? It's changing. If you go back, your early dark days of your career, you were called a stockbroker, right? Nobody was even calling you guys financial advisors back in the 1980s, right?
And there was a time that I was proud of that.
Yeah, of course.
At the beginning of my career, I thought that was a big feather in my cap. At the end of my career, I didn't think so.
Yeah, but that's what people called you, right? And then everybody became a financial advisor somewhere in the 90s, right? The 1990s, they started becoming advisors, right? Now everybody is a financial advisor, and now we're seeing an evolution of many advisors that are in a broker-dealer model, whether that's a wirehouse or an IBD model, are transitioning into the RIA model. And now you're starting to see broker-dealers say, hey, listen, we'll have an RIA, and you can come be an employee at an RIA, right? You can join that shop. So there's a lot of evolution happening in the business. It's really exciting. So that's what, I love having folks like yourself on, because you're showing a path that's been very successful for you and very successful for your clients. One thing I want to do to close it out here, and I thought this might put a pretty good smile on your face here. You've been smiling the whole time, by the way. I want to talk about your artwork, because first of all, it's right there. If you go to the site, you click Gil's website, you'll see your artwork. It's gorgeous. You're doing woodwork. You do painting, and it's gorgeous stuff. Furniture as well. I think one of the question I had was, that's interesting. First of all, most financial advisors, when a financial consumer thinks of a financial advisor, they're not thinking, oh, he's going to be creative and artistic. That's usually not the image that we have of a financial advisor or anybody in finance. But I guess, what was your thought process behind, hey, I'm going to make this part of my public persona, if you will, right? Yeah. Because a lot of advisors struggle with marketing, or what do they put out into the world about themselves? And I love the fact about you that you're willing to share your creativity. As somebody who's an artist myself, I would call myself a dormant artist. I haven't been painting in a long time, but maybe that'll kind of rekindle as my kids get older. What is it about that was so important for you that you're like, I want to share this with the world?
Well, I'm odd in lots of ways, and I might as well make the most of that.
Yeah.
And so one of the odd things about me is that I'm both right-brained and left-brained. I have a very good command of math on the fly. I can calculate yields. I can calculate values. I have a very strong mathematics ability. That is generally contra to somebody with creativity. Mm-hmm. And there is some commonality because I use a lot of math in the way that I do things. And the reason why I named my firm Segment Wealth Management, despite the fact that we do segment our clients, we segment their portfolios, there's segmentation that goes throughout our investment process. But it all started because I did a particular type of artwork called segmentation. Mm-hmm. And segmentation is the construction of contrasting colors of wood cut to fit in a precise pattern, and then you turn something into that, or turn something out of that. Yeah. That normally manifests an inlaid bowl or an egg or some type of a sphere, a sculpture, if you will, that is made up of lots of small parts that all fit together very precisely, which is what makes it look unique when you cut it. And so I had a client in the early 90s that found out that I did woodwork, and she asked me to make her an egg. So I went to my family ranch and I cut a piece of mesquite off of a limb, put it on my lathe, and I turned an egg that was like, I don't know, kind of like this big.
Yeah.
And she absolutely loved it. And so I started making eggs for my clients as giveaways, and I would glue them up in multiple colors. And then I just saw how clients bonded with, oh my gosh, this is so unique, this is so cool. And it was very easy for me to do it and fit within the gift parameters of the broker-dealer world. And so I thought, well, this is kind of unique. And so I just sort of thought, this is a way for me to show that I'm different from other people. I don't want people to think that I'm thinking that I have all of these talents. I have a wide spectrum of talents. There's a lot of things I'm not good at. One of the things that I can't do is I can't draw. I've never worked on it. If you were to ask me to draw a picture of a horse, it's probably going to look like a stick figure.
Yeah.
But what I really can do is take one image, like a photograph, and I can sketch that out and paint it to make the two look alike.
Yeah.
And so having a reference photo is important for the way that I do things. But there's a lot of art that I'm not very good at. I'm not musically inclined at all. I'm not a very good golfer. There's lots of things that I don't do well, but things that are precise, I tend to do well. I was my college billiard champion. I could shoot a mean game of pool because I understood geometry.
Yeah.
And I'm a fantastic dart thrower. I love long-range riflery. I love skeet shooting, sporting clays, physical precision, hand-eye coordination. I have 20/10 vision, despite the fact these are just readers.
Yeah.
I have really good vision and can see very fine details. And so I just enjoy precise things. And it's easy for me to articulate to a client why precision is a very good thing for them with regard to the way we make decisions in their portfolio.
That's fantastic. That's fantastic. And it also seems to speak, and maybe I'm making too big of a leap on this, but you've talked about in the book an abundance mindset, and it feels like, part of this is, I think a lot of folks are like, I can't have all these creative endeavors. I'm focused on my work, or I don't want to share the totality of who I am. So I've done a lot of consulting for advisors over the years in wealth management firms, talking about how they should, be out there more online, whether it's podcasting or video or social media and so forth. And there's always there are some that are really kind of rigid. They're afraid of like letting the world know who they are in totality, if you will. But
that surprises me because transparency is the key to trust.
Yeah,
they have to know all the little bitty details of your life, and the more you can share that with them, the more they are apt to be your friend, and the more apt they are to trust you. And so that's really surprising to hear you say. I think it's a perfect fit for me, but maybe it's just my style. I mean, I am really quick, throw all my cards on the table and just show everybody my life. I don't have anything to hide. Some people may not identify with it. Other people are going to identify with it. And so let the chips fall where they may.
Yeah. Look, man, there's 7 billion people on Earth. You only need, like you said, you only need a couple hundred of them to be very,
that's exactly right.
In your case, 50, as you said, like top 50 clients, or right. So you don't need millions of clients. You only need a handful. And so be who you are.
That's
let
right.
the world know, and you'll attract the right clients.
And it's very calming.
Yeah.
My wife says that when I started my RIA, she found that she was married to a new man. Yeah. There was a certain amount of internal conflict that I had with the way that I wanted to run my business and the way that my broker-dealer wanted me to run my business. And that disconnect created a lot of internal tension within me. So I'm much happier as an RIA.
That's great. That's great. Well, Gil, this has been a fantastic conversation. We went long, but I'm so thrilled we did because you were just so generous with your knowledge and your experience. I think the audience got a lot out of this. We will make sure that we link up Segment Wealth Management and all the contact information on the show notes here. Thank you very much for joining us on the Modern Financial Advisor
Always
podcast.
a pleasure. Thanks for having me.
Thank you. Thank you very much for listening to and/or watching this episode of the Modern Financial Advisor podcast. It's always fantastic to have you with us. I hope you got a lot out of this episode of the show. I mean, listen, one of the, I would think, most successful financial advisors that I've ever met just kind of went full secret sauce on you. Here's how I built it. Here are the things I do. Here's how I serve my clients best. I've done it really efficiently, got a small team. We keep the business simple. He basically gave you a roadmap, and he's written a book that kind of gives you the roadmap on how to articulate these things to your clients. So, I mean, what more do you want? This is a bombshell of an episode. I loved it. This was fantastic. So huge props to Gil Baumgarten. No bombshell, whatever. I didn't do that on purpose. It just happened. Anyway, fantastic stuff, Gil. Really appreciate you being so generous by sharing this type of stuff. Not every advisor is going to do this, right? Share kind of how he or she has built a very successful business. A lot of times we get protective with the information, and Gil kind of looks at the world as, hey, look, there's a lot of this business for everyone. Here's how we did it. Hope other people pick it up and run with it. All right, that's it for today. Please do like and subscribe to the podcast on your favorite podcast platform, and send us in your questions and suggestions for topics and guests for the show, or feedback, podcast@truelytics.com. We'd love to hear from you. And by the way, follow us on all the socials. Just go LinkedIn, Twitter, Facebook, over on YouTube, subscribe, whatever. Love to have you as part of the community, okay? Hope you're doing well. Please be safe and be nice to each other. We'll see you next time on the Modern Financial Advisor podcast. See ya. Bye.